Welcome and good day. This is our third installment of This Week in Review, where we look at the markets, and particularly the banking industry, how bank stocks are doing, and try to give some insight on that, and then look at what's going on from a regulatory perspective or a monetary policy perspective. Okay. This week, which was last week, last 5 business days, today's August 25th, what we saw was a slight decline in the S&P 500. U.S. dollar index is declining, and we saw a slight decline in inflation. And then we saw a shift in the yield curve where the 1, 2, and 3 year yields are going up a little bit, while the 5, 10, and 20 year treasuries or yields are slightly declining. Fed funds rate, our target rate, is 5.25 to 5.5, and we know that's going to be shrunk or declined, or it's going to decrease because we heard from our Fed Chairman Powell at his Jackson Hole speech that it's time for rates to come down. So we're looking for rates to come down in September, either a quarter or 50 basis points. And so that should happen in September. The Fed chairman spoke about it. The minutes insinuated it. So look for it to happen in September, the start of the drop in fund interest rate. So we should see the Fed funds target rate come down either quarter to half a point, or who knows. But I think that's what we're looking at. And then along with what was going on with the yields, U.S. Treasury 10-year yield is at 3.84, so it has come down. And then oil went up a little bit, $4 last week. So that's what's going on in the markets. Also from monetary policy, what the Fed said. But if we look at what's going on with the different sectors in the market, we notice that most of them are going down. There's a little of an uptick in financials, a little bit in healthcare. Okay. And what's interesting, in a late cycle, the business cycle, late cycle recession, we're not to a recession yet. Remember, recession is two negative quarters in a row of gross domestic product. That means we have to see a decline in gross domestic product 2 quarters in a row. That represent a recession. So that's why we might just have a soft landing instead of a hard landing. So, but in a late cycle, look for real estate, staples like groceries, energy, and utilities to go up. It does, and we should look at, again, staples, which is everyday goods like groceries, and healthcare and utilities to be in to do well in a recession. So, but in the late cycle, it's definitely, before I mentioned, real estate, staples, energy, and utilities. So if we go back to our broad market sector analysis, we see that its financials have gone up a little bit, but we also see that healthcare has gone up a little bit. Other than the rest of the market looks like it's going down. Even the ones that are supposed to be statistically, they do better in a late cycle. But this is just last week, so we don't know about the rest of it. If I go on and look at what's going on with defensive stocks, which are the stocks like utilities, staples, things of that nature, those had a good week. Most of those stocks in that area have done well, like retail, restaurants, things like that, pharmaceuticals, utilities, PG&E, for example, Kroger. So companies that would be in the industries that are supposed to be defensive in nature and beneficial during a late cycle, but also a recession. All right, now let's go on to the banking industry, see what's going on there. I'm pretty sure the money center banks are doing well. A mixed bag there, mostly up. Again, in the 52-week range, they're in the top, I'd say top quartile or top 20%. So 52-week high. Especially JP Morgan Chase and Goldman Sachs, those are at the yearly high. The ones not quite that high, well, they're all up there in the, like I said, the top quartile. Let's look at financial institutions diversified, and that's going to include insurance companies, other banks, regional banks. So looking at the diversified financials, financial institutions, of course, some of these central banks are doing well. I'd like to point out the two government agencies that were taken over, federally sponsored enterprises, Freddie Mac and Fannie Mae. They're instrumental in the mortgage home loan market. They're not going to get rid of those. Those are essential to the mortgage lending in this country. So at some point they're going to release them. Those stocks are there. Looks like they're in the middle of their valuation for the year, stock price. For most of the institutions or organizations in this area are in the top quartile. There's some that aren't, so it might be worth the time to look at those and look into it. For example, Prudential's at in the bottom quartile. So it's at looks like it's at $17.42. Might be worth looking at. Okay, moving on to the next thing I'm going to look at here. In the banking industry, and this is a look at the money center banks, but also the service providers that service the banking industry, and also like the regional banks. And most of those went up last week. Now, service organizations like Fiserv's down to its 1-year low, to 114. It's very close to the 1-year low. And then Fidelity National Information Services, another service, a vendor for the banking industry. So Fiserv was mostly the community banks, and then this FIS is also with banks, providing services, data services. Might be worth your time to look at. So that's it for the week in review. We should see some more this week. We should find out this week about what's going on with the job market. So that's going to have an effect on, if we're going into recession or not. So we'll see there. We'll see what happens. Sometime this week or next week should be coming out. And then, so in summary, we saw a mixed bag during the week. Money center banks doing fine. Majority of them were up. The regionals and other banks like that were doing okay as well. So some of the insurance companies were down. So keep an eye on that. Now, again, we're looking at the business cycle. We should be looking at things like, as I mentioned, real estate, utilities, energy, and consumer staples. In the late cycle, then in the recession, it's going to be it's going to be not real estate, but it's going to be consumer staples, utilities, and healthcare. So those three, look at that. Banking. Well, so as rates decline, all stocks should see a boost because of discount rates. You discount the cash flows, and so the valuations of a bank would go up from that regard. But if you have, say, a recession, then that affects the economy, and that affects the health of a bank. For example, loan losses will go up. Generally speaking, loan losses will go up, and the earnings will be hurt from that. Establishment of reserves and write-offs that affects negatively affects the earnings of a bank. So, we want rates to go down, but we want a stable economy. So, but if it's not stable, it's in a recession, then that will affect bank valuations. Now, as rates go up, as I said, in general, rates going up in a stable economy will generate increased profits for banks because earnings will go up. But at the same time, it also raises the discount rate, which has a negative effect on all businesses that have income cash flows. So that's it for this week. Stay tuned for next week. like I said, every week I'll give a synopsis or a summary of what happened the previous week in the economy, in the markets, with a focus on banking. And then we'll talk a little bit about what's going on with monetary policy and regulatory uh, regulation for banks. So you have a wonderful week, and we'll see you here on the same channel at our podcast next week. All right, take care. Have a wonderful day. Bye bye.